Hello everyone, welcome to our discussion of Chapter 6. We're specifically talking about the idea of having your own business or being self-employed and how that income is reported. So thus far in the first 5 chapters we talked really about income that would come like as an employee from an employer. This is when you are the employer, you have your business, and you're going to this trade or business that is engaged in for profit. We're going to look in our discussion a little bit about the difference between an activity that is engaged in as a business versus what is a hobby. And the overall key is that it has to be engaged in for profit. And of course that's a very broad term, so of course that has been challenged by taxpayers and the IRS as to whether or not an activity is engaged in for profit. And so we'll explore some of the details about what would mean that you're engaged in for profit even if you don't have a profit, because that's really important. Because if you are a business, your intention is to be engaged in for profit, and you're acting like a business, and then you lose money, meaning your expenses are higher than your income, then your loss can be offset against your other income. So let's say you have a job, but you also have a business. Okay, so that if your business loses money, and if it's classified as a business because you can show that you're engaged in for profit, even though this particular year you did not make a profit, then that loss, the amount that could offset and reduce your taxable income, all right, from your other income, which would include in this case your job. Okay. If it is a hobby, meaning you don't really engage in it for profit, then the losses have no bearing on your tax return. There's nothing you can do with them. There's no deduction for them. So what, you spent more money than you brought in. Okay, and of course if there is no income at all, then of course it's a hobby. You can't really make a contest that you had no income, no revenue, nothing that you sold, and that it was an actual business, or at least it's very difficult. I shouldn't say it never could happen, because sometimes when you're starting a business, you may have a little while before actually getting some revenue, and you may be very legitimate business and just not have any revenue, but that would be a very temporary thing when you first started the business. And just be aware that if that's the case, if you want to claim a business where there is no revenue, you're going to want to keep extra good records in case that is challenged, because that's likely to be challenged. Okay, so self-employment income is reported on Schedule C. It looks like an income statement. There's examples in your textbook of what that looks like. Okay. Your revenue or gross receipts, typically as you're self-employed without any really thought about, you're going to be cash basis. Okay, so you're going to report your gross receipts when you receive the money. Okay, direct sales to customers if you do work as an independent contractor, and even there are situations where you would be a statutory employee for certain benefits, but you're still considered an independent contractor for tax purposes. Typically, you're going to see, there's examples in your textbook of the 1099 miscellaneous, or NEC is the new form that is for non-employee compensation, and that's sent to you if you are have that as business and you're a sole proprietorship by the one that paid you. They send you the 1099 showing that they paid you and saying how much they paid you. your income or your revenue on your Schedule C has got to be at least as much as the 1099 NECs that are reported by those that paid you during the year. All right. Then, of course, you subtract your expenses. Cost of goods sold, of course, is the cost of the inventory if you're selling inventory. Okay. Now, there are situations if you have inventory as a material income producing factor, meaning you sell stuff, a lot of stuff, okay, then you might need to account for it using the inventory using the accrual method, but you don't have to unless your receipts are over 25 million. Okay, so you can get by with the cash basis of accounting, unless you're a pretty good sized business. Okay, so most small businesses can operate entirely, even if they have inventory, on a cash basis. Now they have to do a little bit of, have to at least account for their inventory, but they can. It's not going to be real particular about that. All right. Other expenses. Okay, and this is where the definition of tax law comes in. To be deductible, it has to be ordinary, meaning it has to happen regularly, and it's going to have to happen over and over again. Meaning, if you buy an asset that's going to last several years, that's not ordinary. Okay, that's considered extraordinary, if you will, because you only have to do it every so often. So that's not an ordinary expense. And so we'll deal with buying assets and how that impacts our income on the Schedule C in our second podcast, where we talk about depreciation. Okay, they have to be necessary, so you need it for the business, and this is usually the thing that is going to be challenged, although all of these can be challenged. Show documentation that says we needed this for our business, not for a personal, but for the business. Now, one of the principles about tax law that sometimes is unclear is when you spend money on something, there could be a situation where it is part business, part personal, meaning you buy supplies, let's just example, and some of it's used in your business and some of it's used personally. Any expense can be separated. If you can identify the percentage that's business and the percentage that's personal, you can still deduct it, but just the percentage that's business is deductible. That's true for assets, and what you use them for a certain percentage. That is a good principle in tax. It doesn't have to be all of it. Most of the time, we're going to allocate an expense, especially when you're running a business out of your home. There's going to be things that you use business and personal, and you can allocate it. Of course, you need to have documentation that tells you how much was necessary for the business and how much was personal, and something you can point to as backing up your contention. And then, of course, reasonable. There is this reasonable where you can't just spend something too much, be extravagant compared to what it is. We run into that in, say, travel. If you travel for your business and it's deductible, it can't be extravagant, though. So those are the basic definition. And of course, those are all very broad, and so there are lots of details, you might say. Some of them end up in court. Some of them end up with questions posed to the IRS and answered in various publications and other responses, revenue rulings, that sort of thing. Now, there are some expenses or costs you could say that are forbidden. If you pay a bribe, kickback, anything illegal is not an expense. And the IRS has gotten criminals that they can't get for other things by proving this. Okay, and famously, Al Capone was brought down by problems with his taxes. Okay, Um, the thing is, the illegal income is taxable, but your expenses are not deductible because they're forbidden. Lobbying, okay, any money you pay for lobbying or political expenses to influence legislation is not deductible. Okay, you can spend it, but it's not going to go on your Schedule C. And then the one that kind of trips people up, fines and penalty payments. You get a parking fine, okay, in your business, and that is not a business expense, okay, because it's basically a cost of doing something illegal, not because you run the business, okay, and that's really hard sometimes to separate out and to do that, but that's the truth of it. You go on a business errand, park illegally, get a penalty. Technically, that is not deductible. All right. Our next podcast is going to be only about depreciation. So that'll wraps up our first one. That's just the basics of the Schedule C.